Welcome to Top of Mind, the show where we talk to real estate industry insiders and experts about the biggest trends impacting the market today. Enjoy the show.
All right, Mike Simonsen here. Thanks for joining me today. Welcome to the Top of Mind podcast. This is where I talk to the smartest leaders, thinkers, and doers in the real estate industry. For a few years now, we've been sharing the latest market data every week in our Altos Research weekly video series with our now new Top of Mind podcast. So we're looking to add some context to the discussion about what's happening. And so, it's more than just the data. So each week, Altos tracks every home for sale in the country, all the pricing. We do all the analytics on the supply and demand and all the changes in that data. And when we make it available to you before it becomes available in the traditional data channels. So visit altosresearch.com for more on the data and what we do at Altos Research. So speaking of leaders in the industry, I am thrilled to introduce my guest today, Bill McBride. Bill is a housing market expert and the author of the popular economics blog, Calculated Risk. This is one that Paul Krugman, Nobel laureate Paul Krugman of the New York Times, called his go-to website for housing matters. Bill may be best known for accurately predicting the housing bubble in 2005 and the bottom of housing prices in early 2012. And, Bill, welcome to the show. You and I go back away to that 2005 time when we both started. I started Altos Research January 1 of 2006 and started blogging along that time. And you were one of the very first people who are in the space blogging at that time and communicating about what you were seeing in the market. So welcome to the show. And I'd love to start with tell us about the origin of Calculated Risk, the blog, and your background before that. How did we get here?
Well, thanks so much for having me, Mike. It's a real pleasure. I looking back, because now I think this is my 18th year. In 2004, I was reading about blogs, and I thought, well, what the heck are these things, And one of the best ways to understand something is just to do it. And so I said, well, I'm going to start a blog. And so I started it in January of 2005. But then, you have to think about, well, what do you want to write about? And one of the things I've always been interested in is economics. I had retired from a high-tech company as a senior executive. And I said, well, I'm going to write about economics, and especially about the thing that scares me the most, housing. So right away, I started coming out, I think there's a housing bubble here. And I think there's something strange going on with the lending. And it was, I think, in the middle or summer of 2005 that I started saying, if this really goes south, we could have a real financial crisis, because there's going to be so much losses associated with it. So, that's really kind of the origin of the blog. I started writing about economics in general, and I still do that. But my focus is always on housing. And I grew up my dad was a real estate agent and then a home builder. So, I think he'd still like to be doing it. He's 99 now, but yeah. So I've always kind of had an interest in housing, even though I didn't follow in his footsteps. I'm more focused on the economics, the macroeconomics of housing, as opposed to what my dad was doing, was putting up sticks.
Yeah, that's right. So wow. So you're in Orange County?
Yeah.
So Southern California is a ground zero of the bubble, the housing bubble, and the financial aspect of the housing bubble, right there. And did you grow up there?
I grew up in San Diego, but I've lived in Orange County for a long time. I have to say, I was at the gym working out in 2004, and there was this cute girl that would frequently work out next to me, and we'd chat. And one day she came in, she goes, "Hey, Bill, I bought a house." Now, I knew what she did for a living. She was young. She was, it's a fairly low paid job. And she started telling me about this $400,000 condo that she had just bought. And I'm thinking, didn't you tell me you're making like 40 grand a year? How does that work? And so she started telling, well, you can get all the money you want, for free. And it was really that conversation. I went home and I called some of the mortgage brokers I knew, and they said, "Oh, Bill, we can get you whatever you want. Just name your number."
Amazing.
That doesn't sound right. And then, I kept running into these guys at the gym. They had this spiky hair, and they look right out of that movie, The Big Short.
Uh-huh.
Those two mortgage brokers he interviewed down in Florida. Yeah, they look just like those guys. And one guy was driving a Ferrari, and and they were just going, "Hey, any equity in your house, man, that's dead money. You got to pull all that out and buy more, build an empire." I said, okay, I think I'm going to write about this.
That's really inside, and the the thing that is powerful, or was powerful about your position, is so many of the rest of us looked at that and said, what am I doing wrong? Like, I was at the time, I was Silicon Valley startup exec, and making good money in my early 30s. But still, I'm living in this tiny little overpriced house. And, you see friends who are like a high school teacher in Vegas with 4 houses and driving BMWs. And I'm like, what am I doing wrong? And so I start questioning myself. And so many of us do, as opposed to questioning what was going on in the world.
Well, there is that fear of missing out. And a lot of people had that, hey, if I don't do this, I'm going to really miss out. We might be seeing a little of that today. And, luckily, we always have to say that lending standards are much better today. So every time I dig through the lending standards today, there's some areas that I'm a little concerned about, but it's nothing like what we saw in 2004, 2005. It was just ridiculous. And so, when I was telling one of the other housing analysts last week, I was going, yeah, I'm looking at the credit, but that's kind of like fighting the last war. We're not, if we were really seeing a problem in the credit markets, a lot of people would be all over it right now. And we're not, we're seeing some minor issues. So overall, everything's good.
That's a great point that, we deal with every day, is that, we went through this big housing crisis. It was a credit driven bubble and crash. And so we look at the world through the lens, and when I publish data on the housing market that is continuing to boom, there are a lot of people, a lot of comments, a lot of social media comments who are ready, who have been planning for the next collapse through the lens of the last one,
right.
The fighting the last war problem. So The question is, what's the next war? When we look forward, what's the risk that we should be seeing, or what's the next war? What's the front for that one? Do you have insight or ideas about what that might be?
Yeah, I do. Well, first, like last year, delinquencies skied with the the pandemic, and but a lot of those people were just going into forbearance, and forbearance is actually a relatively painless process if you come back out of it. And I think the lenders did a great job. The people come back out, they just added a year or whatever onto the end of their loan, and the people they get their jobs back, they start making the payments again. And I never saw that as a big problem, but I know that a lot of people did. Oh, hey, we were going back into this delinquency thing again. We're going to have all these houses in foreclosure. No, that's not going to happen. So there's another last war that people have been trying to fight. But if you want to look for the area that there's probably some real risk, it's in the single family rent, build for rent, buying spree that's going on right now, driven with low costs of money. I pulled up an offering that was at 100%, 105% loan to value based on BPOs, which is, the broker's price opinions, which are not as high quality as appraisals, right? So, and it's already 105%, and it wasn't a $1 billion offering, and I think it went through. It was just under $1 billion, and we're seeing more and more of that. As a matter of fact, I think that if you look at the pro formas for some of these guys, it almost doesn't matter what they pay for the houses. And so when you
because money's so cheap.
Yeah, and then they can turn right around and borrow 100% on their entire portfolio, and be paying nothing. And the pro forma show, hey, things are going to be great. Rents are going to be going up a whole bunch for years. So if there's there's what are the risks of this? First of all, these guys, the amount of money in it isn't that huge. This isn't one of these $10 trillion, $20 trillion mortgage markets, that's going to take down a bunch of banks. But they are buying 25% of all the houses out there right now. And so if you all of a sudden had a slowdown in the number of homes that they were purchasing, that would really slow down the housing market. And all of a sudden, where would we see that? In inventory. So the first places that would show up is all of a sudden people aren't buying everything that comes on the market. So this is an area that I would be a little bit concerned about.
Yeah, that's really a great point. It's been quite a phenomenon the last 10 years, and there's big money behind it. And some of that big money could change very quickly.
Right. That's the point. What I'm looking for is if there's a rapid change. I don't think that there's a financial crisis component related to that, but there could be a rapid change in the buying pattern. When those guys started really buying in maybe 2009, 2010 in some low price areas, and then really buying in 2012, 2013. I mean, that made absolute sense to me. As a matter of fact, I knew people that were doing it, and I mean, you clearly are getting good prices on the houses, and you're getting good rents, and it was at that same time that we saw a nice surge in rental demand because demographics were really positive for rentals, which is now they're switching over more to be positive for homeownership. That's been a key component of this frenzy that we're seeing right now. And that's one of the things that sort of makes it make a little sense is there is this big cohort that's moved into the home buying age group.
That's right, the millennials.
Yeah, and 10 years ago, that cohort was in that renting, and also at the same time, you had a bunch of people who got foreclosed on. They had to go live somewhere, so they were renting. As a matter of fact, I had a tenant that got foreclosed on, and that was going great. He rented one of my places, and so. And was quality renter. He just overpaid and got burned. And so that's the area. And I think what we'd be looking for is your data. And if we start seeing inventory coming up, surprisingly, then that might be a flag.
That'd be it. You mentioned it, like investors buying 25% of homes right now, and I think. Are you using the folks at John Burns publish a number about that? Is that where you're getting?
I think I saw that number from CoreLogic.
Oh, CoreLogic. Okay.
Yeah, what 20 to 25%, something like that.
And I think, correct me if you think this is wrong, but I think that includes individual investors, not just the institution.
Yeah, it does. It includes individuals.
And that's actually an interesting thought. So from our data, we can show our inventory chart that declines every year as more of those homes go from single family resale to rental properties. And a lot of that we've observed is individuals buying the next house and keeping the first one as a rental property.
I see that all the time.
You see it all the time. It's been a great deal. It's been a really good deal to build your little your portfolio. And so one of the things that I think about that, even if money is no longer cheap and it becomes less of a good deal to do that, for those individuals that have already done it, and maybe they have one or two or three homes and they moved and kept the others for investment, those are locked in forever at cheap money. So
Right.
those
Yeah.
aren't coming back on the market, right?
It rarely makes sense to sell them.
Yeah.
That's one thing my dad always used to say. He goes, "The only mistakes I ever made was selling."
With selling. Yeah.
Yeah.
Buy
And
low, sell never.
yeah. And very, very Japanese view, I mean, they've been doing that for years.
Yeah.
but and that it clearly drives up the property, and it pulls a lot of properties off the market. That's one of the things we saw happen in that 2011, 2012 period, was a lot of these really low end properties. I remember that you could be picking up condos for around under 100 grand in San Diego. Um, that would be renting for, you could be getting 1,400 a month on. It was ridiculous.
It's nuts.
Yeah, I mean, it was mind blowing, and so but that's not happening now. See, I don't know. The numbers don't make as much sense today. So to me, and I look at when I look at the demographics, I do think that there's been some household formation as people move out of, maybe younger adults living with their parents and stuff. But that's not something that I think is going to sustain. So,
yeah, let's talk about that for a second. So you've done some writing on household formation. We had a big surge. We've got the millennials. And then what's interesting is some folks like Ivy Zellman have talked about how Zellman thinks that we've been building enough homes, so we're not underbuilt. Right. What do you think about household formation, population, and those trends in the next few years?
Well, let me say this. First of all, Ivy Zellman's first rate. So
first rate.
When she speaks, everybody should listen. I think that the general view out there is there's 5 million too few housing units out there, and she's coming out and saying, "Well, no, I don't think so." And first of all, when you talk about the number of housing units, a lot of it depends on price. There's a lot of families that double up that wouldn't double up if things were a little cheaper. So, some of that depends on what price we're at. If rents were much cheaper, people would have, families would split. And I'm talking. You see that all the time in immigrant families where the kids stay with their parents a little longer because everybody's trying to save money and help out and everything. So, and we'd see less and less of that. So, there is a price component to it. But my view is that the millennials are in the age group now of preference for homeownership. Not everybody, of course, but so it made sense. As a matter of fact, I think I first started writing about this in 2012 or 2013. Hey, we're going to get a real drive on homeownership around 2020. And the first time I talked about it on TV, the people were just like, "Why are you even talking about 7, 8 years from now?" And I'm going, "Oh, because it's always good to plan ahead a little, And but now, when you look at what's going on, is that made sense that we would hit this move to homeownership, but that should have made sense that we would have fewer renters. But now we're seeing, with rents going up and vacancy rates dropping, we're actually seeing more renters too. Where is that coming from? And that has to be these people moving out of their households, or maybe some people getting divorced after the pandemic, unfortunately. So there has to, but none of the reasons I could figure out for why we're seeing total household formation, both homeownership and rentals going up, none of those would seem sustainable to me. So I don't think we're going to get this push on household formation. Now, the millennials are still going to want to buy. Yeah, that's going to be true. So there's going to be a preference for home ownership. But I don't think total household formation is going to continue to drive up like it did clearly in the last year. Even though we don't have the numbers, I'm inferring that from both home ownership demand and from rental demand. So I'm inferring that there must be household formation.
So, okay, yeah. So you see a decline in the pace of homeowners of household formation, which is basically.
I think it's going to slow. And remember, over the last 2 years, I mean, back-to-back years of the slowest population growth ever in the U.S. Percentage-wise.
We shrank, right? We shrank this year.
Yeah, I mean, I think that's true, and I mean, it's between the excess deaths and the lack of migration, immigration, and yeah, I mean, it's going to be another tough year, and probably all through this. I mean, it's just that's lower population, and so we're getting household formation without population growth, which is interesting, which means that we're going to see another drop in number of people in households, and that number comes out a year or two late. But we'll start seeing that.
So, at what point do we see that in some of the demand metrics in housing, or starting to see some of the, we've had, both pandemic and economy driven and cheap money driven household formation. So does that hit in 2022? Like, is there second half of the year, all of a sudden people are backing off? Like, is it that quick?
Yeah, the problem with housing is it moves slowly, or maybe that's good because
it's all rear view mirror.
Yeah, you can be very patient. It's a slow moving. I mean, even when in 2005, I go on, when's this going to end? And the flag, of course, was the second half of 2005 when the inventories really started increasing sharply. Yeah. I said, okay, there it is now, and then prices started falling in 2006. So that's why. The answer is I don't really know when it's going to happen, but I know what inventory will tell us if it is happening. Yeah. It's possible that we could see this household formation go on for a few years at a very high level as people pour out, because we did have record number of young adults living with their parents a couple of years ago. We know that by the time we get those numbers, it's going to be less now. Where are these household formations coming from? It has to be a lot of it from that, but. And that may continue for a few years. That trend may continue, or it could slow. That's why the focus is always on inventory, because if we start seeing inventory going up, we can start asking why. Are the investors buying fewer homes? Are these household formations slowing? Whatever the reason is, but this isn't anywhere near like 2005 where I was going, it's coming soon. I just, and then it happened. So, we could easily go through 2022 and still have no significant increase in inventory. Although I do think that by the end of this year, we'll be seeing year-over-year inventory increases, just because it's so darn low.
It's so low.
And one of the things I'm watching your numbers for is if the bottom is earlier this year, more in a normal season, as opposed to last year when we saw the bottom in April.
Yeah.
I mean, that's insane. It's usually in January or February. Going all the way to April was crazy. And that really was a sign that there was something going to continue. And when you get to house prices, wow. I mean, house prices, when you have record low inventory, house prices are going to still be pretty hot to start the year. Now, if we do see the inventory come up, then house prices growth will slow. That's just, that's how it works. So,
yeah.
And I expect inventory to come up. I don't know if we'll get back to those 2017, 2018 type numbers. I don't think so, but
a little bit more.
I'm looking. I pull up your numbers first thing every Monday, and I'm just looking to see if we bottom maybe in January or February, and then start seeing that year-over-year number, which is actually not been getting smaller; it's been getting bigger. The year-over-year decreases, and I'm going, wait a second, what's going on here? It's really hot out there now. It's really a frenzy.
Yeah.
And in January, when everybody's supposed to not buy houses.
Yeah, I have two thoughts that I want to pursue. First is one of the things on that inventory number as a risk for future price declines. I'm not sure if you've noticed this, but for us in the Altos data, we could do we could look at not just inventory levels, but essentially inventory per capita, or flip it around, people per available home. And the more people per the more inventory per capita, we could essentially plot a correlation of the greater inventory per capita was there was not just inventory absolute levels, but
Right.
we could watch, for example, Las Vegas's inventory per number of people who live in Las Vegas was way out of whack compared to San Jose. And so when the prices adjusted down, like we could see that Vegas had more to adjust back in an affordability sense,
Right.
than San Jose would. Have you ever thought about it in that level specificity?
I no, I don't really look at that level. So
Okay, well, that's
I
something we're going to keep an eye
I
on.
have for some local markets that I'm very interested in, but not generally, and
That's
not
fair.
anything I ever write about. So.
Yeah. And then I had another thought that I wanted to pursue there, which I will have to come back to because I've lost it now. So
We all get older, Mike.
yes, I know it's like a mind like a sieve. Um, so um, so here's a question I have for you. Have you looked much international? Do you watch the markets internationally?
Not really.
You know,
I mean, some of them are crazy. They make the U.S. market looks normal.
and that's my question for you. So, you know, we know that inventory is tight everywhere around the world, and that not everywhere, but in most of the Western markets, and prices are rising. Canada's nuts, um,
Right.
and so that says to me that maybe it's not an underbuilding phenomenon in the U.S. It's a global phenomenon, demand driven. Any thoughts on that? Are
Well,
we
I
that
haven't.
unusual?
I've seen the numbers for some of the other markets, whether it's Australia or Canada, and it does look nuts. Um, one of the problems is you have to really kind of understand the local market to understand what's happening. I mean, in all of the Western world, population growth has really slowed, and so and it seems lending's pretty solid worldwide. So, is it the low rates? I mean, that's what driving it? Maybe. When I'm thinking of investor buying, I mostly I'm thinking U.S. Is there a lot of that going on overseas? Probably in some areas.
Yeah.
So, I don't really know. I wish I had a little more time. I would look into some of those markets. People are always going, well, what about Canada? What about? I don't know.
Yeah. And
I do know a little about China, but
oh, do you?
that's when yeah. It's one of the interesting things in China is, they build like crazy there, and although they're starting to have problems now, but when you build a condo building in China, uh, you don't build it out like you do here. You have a space. It's like an office building kind of, and then the people who lease the space build it out, well, or buy the space. And so if you buy there's a whole industry there that comes in and builds your kitchen and bathrooms and stuff in buildings that are built by the original developer. And so and the owner does that. So it's a little different process in the U.S. When you sell a condo in the U.S., it's built out. You come in, you got your beautiful counters and everything's done, right? Not in China. And then what they do, at least, and they may have changed this recently, but they don't have a property tax if you don't build it out. They only charge you if it's built out. So what a lot of people in China were doing was just buying these vacant condos and not building them out as a place to park their money.
An option.
Yeah, they're going, hey, I don't trust the stock market. I don't trust this. I don't, look, they grew up under communism and still are. And so they don't trust a lot of things, but hey, I own this space in this building. And even though it's not built out and it's not returning any money, I own it. And so there was a lot. So people would always say, oh, look at all the vacant units in China. And I'm going, yeah, that's because people are parking money. So that's why you have to really understand what happens in each country. That wasn't that wasn't this massive overbuilding that the developers owned all these. As a matter of fact, the developers have sold them all, so they go on to their next project. Now, there are some things in the last year or two that have come to the surface that are, where people are over leveraged and they're having financial problems, as we know. But that's completely different. I'm talking about 7-10 years ago when people say China was going to implode. I go, no, they're not. Maybe they will now.
maybe they're at the curve. Yeah. So many variables in the world, and it's I would say that the U.S. real estate market is so messed up that Alto's research has to exist. If it had its, but it's not quite so messed up that we can't exist. Like in some countries, like even in France, you got to know the guy who's got the listing. Like you don't know what's going on. It's really fascinating. Or like one company controls the whole market, or we just happen to have a sweet spot of just messed up enough in the U.S. that
well, there's in a tight market like this, there's plenty of pocket listings out there. People they never get to the market. If it's somewhat reasonably priced, it's the broker's getting both sides.
Yeah, and what do you think of that trend? That's we see it as, we call it immediate sales, where house is listed and then it goes immediately in pending state, and the one of two things is happening. Either they list it, they take offers, and then they turn it around in a couple of days, or they've already got their offers done and they just list it for a day, or and then make it pending because it's already done. What do you think about that trend? Is that like,
well, first of all, I don't think it's necessarily the best thing for the seller, because I think it is much better to get multiple offers, especially in a hot market. In any market, that's true. So I think that I do think that some sellers don't like having a bunch of people going through their house, and so they they're willing to, here's a good offer, and so they're willing to go ahead and do it without getting multiple offers. They think, oh, that's what my neighbor got, so that's good price, or I'm getting a little more, whatever. So, but my view is, I also don't think it's really, I don't think it's good for buyers. I mean, they don't ever get a chance to see these houses. I don't think it's good for sellers. I think it might be really good for the agent. So I tend to not have a great opinion of that. I know it happens all the time. I see it happen all the time. So, and look, right now listings are gold, and the truth is they're always gold. So even in a bad market, having a listing is nice. Every agent out there knows that. So I remember my dad, when he started a real estate agency a long time ago, he had two guys that were. It was a guy who was a gym coach, and a woman who was just a real go-getter, and they were his top two agents. My dad was a broker, and the one person, the gym coach, never sold a single house. What he did was he was friends with everybody through their kids, and they would all list with him, and he looked like he was a really active sales guy because he had all kinds of sales and all kinds of listings. And the other woman, she didn't get that many listings, but she sold things like crazy. And they're both making about the same amount of money, And I mean, listing. My dad used to say, "This guy's magic. He just gets listings like tell your parents that they're going to sell, or he knows when the kids will sell. And hey, we're thinking of moving. He'd be calling the parents, And so, but right now, my gosh, when there's no inventory, every agent I know is saying, "Hey, Bill, you hearing about anything?"
Yeah, or like all the techniques for trying to pull listings to market. It is a good time to sell, especially if you've already got something else lined up.
Yeah. Well, that's one of the things. That's an interesting point, because one of the things sometimes we see is people don't want to put their house on the market because they can't find anything else. They're really worried. I actually have a friend who just sold something, and the people wanted to buy it, but they wanted to. They were really nervous because they wanted to make sure that they didn't want to list their house, because if they sold it and then this didn't go through, then they were going to be living in their cars, so you have to make sure that keeps the inventory down because people don't want to list their houses unless. But that can work in the opposite direction too. Everybody will say, "Oh, well, now there's a lot on the market. Now I can list because I have things to choose from." And then of course you can't sell. And then you start getting all the offers start coming in contingencies. You're going, "Oh, I hate contingency offers."
Yeah. I wonder, like, are there, like, what's the way out of that for home buyers and sellers? Like, how do we, like, what's the way to navigate that this year?
I don't know if I'm the right guy to talk to about that. I think you should. I mean, talking to some agents and brokers. I mean, they probably have some good ideas.
Yeah. Yeah.
I,
All right, let's switch.
From an economic perspective, I don't know.
Yeah. Let's switch back to the economics then. Let's talk about the next 10 years. So we talked a little bit about household formation and that's likely to decline, which could be one thing in the next few years, especially as the millennials age, we start to get a little more inventory, and maybe as the boomers age out.
I wrote an article, back in September. I think it was called "The Next Big Shift," and I feel like it's kind of the same thing I did with the millennials coming for buying in 2020. Is if I look at my parents' generation, and it's not monolithic, but people started moving into retirement communities around 80. And I think it's going to play out somewhat the same way. Now, a certain percentage of people will always age in place. That's always been the case. Some people will move to retirement communities, whatever. But I think you start really seeing right around when people turn 80, and the oldest boomers aren't 80 yet. They're maybe 77 or something. Built. Yep. 1945 or something, or 46 is the start of the boomer generation. So, that we probably are going to see, and then the first few years of people turning 80s isn't a big deal. It's when you start getting a bunch of people turning 80, right? Just like you got a bunch of people right now going under Social Security, right? Because they're all a lot of the boomers are in their 60s, early 60s. So what we'll probably see is maybe at the end of 2030, we'll start seeing more inventory. Now, one of the interesting things is there's some real opportunities there. We'll see inventory in good areas because that's where the boomers live closer to everything, right? They bought long ago, but we'll also see that a lot of those homes need improving. So there'll probably be a real home improvement market going on. You come in and you go, oh. And of course, nothing you can do about a low ceiling, but you can redo the whole kitchen and bathrooms and make it more modern looking. So, or maybe you just do ground up. And we'll probably where I live, that's what everything happens goes ground up here. Yeah. But I live in a nice community and near the beach. So we'll probably see that starting to happen towards the end of this decade, and that would be more inventory coming on the market. The millennials will probably be moving up at that time, the homes that they've already bought. So they'll be very anxious. They'll probably be wanting to buy some of these homes, not because they're great homes, but because they're in good locations. And really location matters completely in real estate. Everybody makes it a joke, but it's really true.
It sure is.
You want to be in the right spot, and you don't want to be on a busy road. And last year I was telling people the prices made me nervous, and because if you look at price to income or real prices or price to rents, whatever you want to look at it, we're definitely expensive right now. But I told people, hey, if the house makes sense to you, go ahead and buy it, but don't buy anything, if it's on a busy street, it's always going to be on a busy street.
Yeah.
If you're down in a gully and have water issues, you're going to have water issues for the rest of your life. So I mean, there's defects that you can't cure, and so I would say, and that's when those houses move, by the way, in markets like this. I know an agent in town who knows all the really crummy houses, and he's out talking to all those people, saying, "Hey, this is the time to sell."
That's an interesting strategy for an agent.
Yeah, I mean, you go, look, if your house is on a busy street, now's the time. When are people going to want to buy it? Right now, because there's nothing else, right?
Yeah.
And there's other times when you can bring a house on that's on a busy street and it'll just sit, and you just kind of cry, because you can't move it and you don't want to cut the price too much. So now's the time for all the defective homes to come on the market, which means for the buyers, they need to be aware of that. You feel like you have to get in, that fear of missing out, but don't buy a defective home. A home that you can't fix whatever the defect is, or it's really expensive to fix.
Yeah, when people ask me, do I buy now? Do I wait? What if I'm buying at the peak? What all these questions, and my rule of thumb is, if you love the house and you can afford the house, buy the house. If you can't afford it or you don't love it, don't buy the house. Don't buy it because you think you have to.
Yeah, that's good advice, because I mean, if you can go in, you can afford it, you love the house. I always tell people, hey, if you can live there for 7 years, you're gonna be fine. If you bought in 2005, see, I was telling people don't buy in 2005 because I was saying that you're really going to see prices drop. I mean, I can't make that prediction today. So, but even if you bought in 2005, so what? You're
right.
If you like the house and you were underwater for a number of years, you're not underwater anymore.
That's exactly right. And the difference between now and then is that you have a 3% mortgage now forever. And then if you got into a house you couldn't afford, you had an exploding mortgage and you couldn't afford it very quickly. And that's the difference. Like, that does not exist anymore. And so if you can afford it, you will be able to afford it probably forever.
Right. And, ability to pay was one of the big rule changes. And even some of the loans, like the non-QM loans, they still meet the ability to pay rules. And so, that young woman I was telling you about that bought that $400,000 condo, when I was asking her, she was paying 1% teaser rate for the first year or maybe the first 2 years. So I was, well, I mean, they're basically incentivizing you to move into this place. I mean, it was less than she was paying in rent somewhere else, right? I mean, and I'm going, well, it's not going to be 1% forever. Even in today's market, it would triple, right, up to 3%. So I mean, these are not comparable periods. On a graph that you see the house prices, they look very comparable, but the reasons behind it are very different. So, although it still makes me nervous.
Yes, because it has been so crazy. What do you think about the pandemic migration, the Zoom towns, the remote work trends? That such a big deal. Do places like we observed, like I have a home in Tahoe, and it exploded with remote work from the Bay Area or Bend, Oregon, or Boise. Does that continue? Does it crater? What do you see happening there?
I really don't know. I think people like to live in the cities for a lot of reasons. Work is obviously one of them, and that's the one that you're talking about for certain workers, white collar workers, say. But we like to live in the city for other reasons too. I mean, if you talk to people who live in New York, man, they just love New York, and you go out to so many great restaurants. You've got all the plays, you've got whatever. The museums are awesome. We have a fair amount of that here, not to that level, of course, but every city has those kind of amenities. So that's, yes, people gather to work, but I think there are people gather to do social activities too. And so, and so when you move going to Tahoe, I mean, I love Tahoe, but I don't think I could live there all the time. You get a little island fever, and maybe I could handle Hawaii 24/7 for 365, but probably not Tahoe. And look, I love to hike, I love to ski. So, I think I would go a little stir crazy. Um, I mean, and I love the mountains. The mountains
Yeah.
are always calling. So, it's just I think it, and look, certain people have moved to other strange places like Idaho, and I know a couple that moved to Indiana from the Bay Area. They both could work remote, and they said, "Hey, we can buy this house for pocket change." They wrote a check, and they were renting in the Bay Area, and it was killing them. I mean, so what a difference! Now, the number one thing they were looking for was good internet. so, but the thing is they're away from their family. They're the area they're living in is a small town. It has good internet, but I mean, maybe they'll love that. Maybe it's a younger couple, so maybe they'll have kids and enjoy raising them there with their real yard and all that. So,
Yeah.
I don't know. It's predicting all that behavior is really hard. I mean, will people work from home a lot more? Sure. I mean, that was a trend that was already happening for certain white collar workers. I know a lot of lawyers who were working from home half the time already before the pandemic, and so it's no big deal. They were already set up. You can do it. So yeah, I think it's a trend that will continue. I just don't know how much that'll impact housing. I mean, you look at New York right now, and New York people are pouring into New York, right? Well, maybe not this month because of the new wave, but yeah, I mean, it was it emptied out in March or April of last year, and but that's all behind us.
At
People
the end of
are
the
back
day, New York is still New York.
and say, hey, where you live in San Francisco, right? San Francisco is going to be San Francisco.
Yeah.
I think it's sort of amusing that people have a negative attitude in San Francisco. Because if you go to San Francisco, most of the areas you don't see bums. You don't see. I mean, there are areas where you do, but San Francisco is beautiful with great amenities, and so it's kind of amusing to me. Is I've actually been in areas where there was a major news story, and it was in a 2 block section. You're outside that 2 block section, and the people leaving, as soon as they're off camera, they behave differently.
Yeah.
So every time I see a negative story on San Francisco, I just laugh.
Yeah.
That's not San Francisco.
Well, I am
say
an
that.
unabashed San Francisco propagandist. So, I got, but it will be fascinating. There's some real changes and things underway in San Francisco. And, because the city and the tech companies were so easy to be remote, they haven't really come back yet in the downtown area. And so there's
Right.
there's still some real things like it's going to be fascinating to see. A lot of them were aiming for January, and all of a sudden now the rules have changed again. So maybe
Right.
January, maybe it's another few months. I think it's about to change. We signed a lease downtown, and so it'll be really interesting. Like 18, 20 months ago, you couldn't get it. Like it was not available, not at any price. And
Right.
so so we signed one, and I signed it in whenever it was August or September, and maybe I was a little early on it, but it's fine. And I like being down there, and so it will be fascinating to see as we hopefully, fingers crossed, finally emerge from the pandemic.
But we're talking about residential real estate, but there some areas how offices may really lag for a while. Leases come up 5, 10 years or whatever, and when those leases come up, people may say, "Yeah, I only need half the space now," because people are working from home a lot more.
Yeah.
And we see retail's been under pressure for years from the online buying, and the pandemic just really crushed retail. So there are sections of the commercial real estate that are struggling. I
For
mean,
sure.
even hotels are they're not back yet. Their best customers, the frequent ones, are the business travelers, and it's the leisure travel that's come all the way back. It's not the business travel, and because I think a lot, and that says that a lot of business people, are doing Zoom instead of flying. So you can't. You still have to meet face to face, and that'll always be best. But you can minimize it a little bit, or at least for a while. Now, I hope you're right. The pandemic's behind us, sometime this year. I was really hopeful at the beginning of last year when the vaccines came out, and then but this year, this may be a much more mild variant, and we are starting to see some pretty good therapies, right? So with those two combinations, we could see some real progress. I'm starting the year hopeful once again.
Once again.
Yeah, once again. Hey, mid-year will be all behind us. I'll be out doing everything, and some of my friends are already out doing it.
We are in my sort of community, and it was fascinating. We have been a lot of the year, post-vaccine, a lot of the year, and a lot of gathering, and really essentially no impact. Tiny little bit around Delta, like in San Francisco, almost nobody had COVID the whole time,
Right.
Until December 17th, and then everybody had it. And like all the rules changed. Omicron happened, and then it just exploded. Hospitalizations are very low still in San Francisco, like all of those, because the vaccination rate is so high, that fingers crossed we get our curve down, and
Right.
we start to see some normalcy this year.
Okay. But I live in Orange County, and we have some of the most anti-mask, anti-vaccine people on the planet, and we do have problems. Occasionally, it flares up. Right now, of course, hopefully we'll work our way through that. I am optimistic that the therapies those appear good. I mean, things get better and better. If you look back at the AIDS crisis, say, I mean, gee whiz, it was a death sentence, right? And Magic Johnson got it, and we were all going, oh no, he's not going to play for the Lakers. Oh no, he's going to be dead in 5 years, right? He's still around. So and doing and healthy, So that we're going to see that kind of improvement over the next few years. This may be around forever, but it may be something that's easily treatable, or we get an annual vaccine or whatever, but no big deal. So we're going to get back to our normal lives. Now the normal lives may be very different. They may be more work from home kind of stuff, interviews like this, and I'm sure that we'll do that. I mean, a lot of good has come out of this. All the technology has been awesome.
Yeah, really. The remote Zoom competency has been, I think, a real boom to the economy. I think it'd be really powerful.
Yeah.
All right, Bill. Well, I just have to say, I really appreciate your work with calculated risk. Your analysis and insight is always so cogent and independent. Like you're coming at it just saying, "Tell me what's going on," as opposed to having a book to talk. And I think it's obvious that you've been doing it for so long that you've gotten over the years a lot of attention for that work. So I just wanted to say thank you for doing that work, and thank you for joining us today. So I know you're doing, so we have Calculated Risk, the blog is calculatedrisk.com. Is that the URL?
It's calculatedriskblog.com.
Blog.com. And you're doing a Substack now.
Yeah, I'm doing a newsletter too.
So where can people find that?
It's Calculated Risk Substack. So if you go to my blog, it's right at the top where you can go get the newsletter. I write an article 3, 4, or 5 times a week, depending on how I feel. And I started doing that just because it's more of a focus on just real estate. And why? It's kind of the same reason I started the blog. Real estate is really interesting right now. So there's something happening, and I'm not sure what it is. And, and I remember when I started thinking in 2005, man, this is a bubble in this lending, but how can people lend money? People don't lend money. I wouldn't lend money to lose money. right? And it was really when you started figuring out how the whole process worked, you said, oh, well, here's how it is. Everybody, it's little hot potatoes, Watch the movie Margin Call. I don't know if you've ever seen that movie.
Yeah.
But, they're going, oh no, we're stuck with all this junk for 30 days. We got to get it off our books. And that was all. People were just. It was the hot potato. If the mortgage broker would hand it off to New Century would hand it off to Bear Stearns would hand it off to some investor, and everybody made money on that one.
Yeah, it's so fascinating.
Yeah, when it ends, everybody gets stuck.
Well, we're in a very different space now.
Oh, completely different.
All right, Bill, thank you so much for joining us today. Any last words?
Well, thanks so much for having me, Mike. I know I just ramble at times, so cut all that out of me.
I love your insight. I love your take on all the data. I appreciate the work you do.
Hey, and I really appreciate you sending me your data too. It's awesome. So it really, to me, it's incredibly useful. Just I go through what you send me every week, but the inventory obviously I focus on.
Yeah.
But and I keep waiting to see that market index change. It seems like it's stuck.
It seems
I don't know if that meter's stuck or.
It cooled off a little bit in the fall, but now it's turned around and come back up again.
Yeah.
And for listeners, if you follow the Altos research video and the work we do every week, if you follow Bill Calculated Risk on Twitter, you'll actually see him scoop us each week because he always publishes his Twitter analysis earlier in the morning than I get on Mondays, and then we get our data out. So you can actually follow Calculated Risk for that insight as well.
Sorry to scoop you, Mike.
Yeah.
Thanks so much for having
My pleasure.
me. It's been really fun chatting.
Thank you so much, Bill.
Okay.
Bye.
Take care.
Thanks for listening to Top of Mind. See you again next time, and be sure to click subscribe to get future episodes.